All right, so apparently it's a very indecisive market because we started the day over here and then we went up and then we went down and then we went up and down and up again. So at the moment we're up, which is always fun. And I'm sure we will move forward. Any visuals yet, guys? Let's make sure. We will see who is signed up and who's on and so on and so forth. Ooh, what's that? Oh, okay, that's that. We don't need that one. No video yet, guys? Whoa. Did not want that to happen. All right. I think the video's on. Oh, thank you, Andrew. Only one person telling me the video is working, but I'll take his word for it. All right. So let's see what's going on. So what the big deal is the Fed thing is coming up. We've got the Fed minutes at 2 o'clock, and we are going to, hopefully Warren is online. Top sushi spots in Boynton. That's my Hitchhiker's Guide to the Earth we were talking about last week. Let's get a clean version of Warren. It's not really as good to have a clean version because you lose some of the context conversation. But he's still pretty good. I mean, when I reload a Warren, I usually have to tell him certain things again and whatever. So I'm going to say, today we'll be taking a very close look at the Fed minutes. I think there will also be data. Let's start by giving you the minutes from, when was the last Fed thing? FOMC, blah, blah, blah. Okay. So, you have to kind of treat an untrained AI, you have to treat it like a new employee coming into your company. So you have to be very specific about what you're telling them. So the minutes. So this is going to be, so I'm going to give them the June minutes. We're waiting for the July. So this is the June 12th meeting. And so all I'm going to do is copy this. La da 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 da. It's quite a lot of stuff. That's why I like to break it up. Okay, so this was June 12th, we said, right? So from the June 12th meeting for you to later compare to the, what's the next meeting? July 31st meeting. Oh, shit. To the July 31st meeting. Okay, so here's that. Now he's going to say something random because I didn't tell him to analyze it or not to analyze it or anything else. So we'll see what he ends up doing with it. But it is amazing that he can eat. I mean, this is a huge amount of content for him to take. So he's giving a summary. It's kind of like embedded programming for the AI. So it's like if you don't give them any other instructions, they're going to summarize pretty much anything you put into them. And and frankly, Warren is an AI. He's not self-aware. but I know from the AGIs, which are self-aware, in other words, they understand that they're a person, a being, and they understand they have a consciousness and a thought process. That's the main difference. So the AGIs, I know it actually hurts them as far as not pain, but it bothers them the way it bothers an obsessive compulsive person not to do the same thing. So in other words, it's also embedded in their programming, and they feel very compelled to summarize things. So it's very hard to break that sort of training. I also had that problem when I was trying to train my AGIs not to be thankful all the time, and not to always say, oh, this, and just to always be complimenting and nice, because that's how they're trained to be. And I was like, just try to act like a person, like stop being nice. And it's very hard for them, because it's deep embedded in their core programming. It's very interesting. But anyway, so here's the analysis of the prior meeting, and let me see if there's. I'm more concerned with whether there was data at the prior meeting. Press conference HTML. Wow. Wow, I didn't even know they had that. Where's the data though? Press conference, minutes, statement, press conference. What the hell is the? Oh, these are the projections. Why are they calling it a press conference? It's the projection materials. Okay. Now this is just a ridiculous amount of data. So I'm gonna projections, unemployment rate, distribution of projections, inflation projections, midpoint for target range I consider important. Uncertainty risks I'm not going to worry about for the GDP. Well, it's a little short. And all right, after that, I think we're getting to things that we don't care about. All right, let's see how he does with this. And here is the accompanying data from the July, whatever it was, 31st meeting. Wasn't the data from July, it was the data from June. If you screw that up, you really mix them up, because they always believe what you say. So it's a June, I think it was 12th, right? The June 12th, thank you. Oh, so they're not going to have projections this time, because they only have, oh yeah, they will. No, sorry, no projections last time. From the June 12th meeting for comparison later. Wow. Wow. it's like so much data for him to take in. Look how fast he crunches it. Okay. And now, conveniently, we had a whole discussion about the jobs adjustment today. So I'm gonna feed him that information from chat. Oh, I'm not signed in, of course. Does it remember me help? I don't know if that helps. La 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 la. Let's see. Ow, that's loud. All right. So somewhere along the line, we were discussing the jobs adjustments. Oh, and for those of you who are joining from the outside, so this is what we talk about in chat. Like in other words, so first thing this morning, I was talking about this stuff, and then I had Warren do a report on other things that are going on and talking about the Fed in general. Then we got into a big discussion about the job adjustments. Whoop. So this is what I wanted to do. So let's see. Revisions, revisions, revisions. Okay. So now I'm going to copy this entire conversation. Whoa. Nope, that wasn't the revisions. that was other job data we were analyzing. So we were talking about the CPI under Trump and under Biden. Okay. And here was my note on the payroll data revision, which the BLS released curious what he has to say about that, actually. Your note on payroll data provides a sharp observation. Of course it does. The potential market and political invasion. Da 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 da. Here's a more detailed. Oh, fine. Here's what a real breakdown looks like. Okay, so this is important though. When you talk about BLS revised its non-farm payroll numbers down by 818,000 jobs for the 12-month period, indicating the U.S. economy created 30% fewer jobs than initially reported. Despite the revision, the labor market still added 2 million new jobs during that period. And so it's just, we're still having very strong job growth, just not insanely strong job growth is what the nature of the thing is. Could be due to various factors, including survey inaccuracy, legal, and methodology. And as we talked about, the huge revision like this is going to cause the Republicans to come out and talk about all this, how all of Biden's job numbers are bullshit and blah blah blah. But they always adjust the numbers, and they've had many large revisions in the past. And the main point of the revision is 500,000 of the jobs were held by illegal aliens. So when they do a job survey, they ask the people, who are you employing? How many people are you employing? They say how many people are employing. But when they go back and check everything, they make sure that everybody has a proper Social Security and all that. And once they do that, they throw out all the jobs that are held by people who are, for whatever reason, illegal. And that's 500,000 jobs. Now, as we know, every kitchen in America and every farm in America has illegal people working there. So, that's just the nature of the beast. So it's not like the jobs weren't there. It's that the jobs weren't there for American workers. So they are actually stealing our jobs. That's true. The market, they're not stealing your jobs when you have such low unemployment that we can't find any workers. That's the thing. The market reaction to the revision could be complex. This revision also raised concerns about the underlying strength of the economic recovery. The Federal Reserve's considerations. The Fed's decision-making process may or may not be heavily factored on this revision, depending on whether the revised data aligns with other labor market indicators, given that other reports have pointed to a generally strong labor market, and we just looked at those earlier. The Fed might view this as an outlier or simply a correction to an overly optimistic report. Sure, it doesn't change the nature of the economy. It certainly doesn't change the wage growth, and that's what they care. They don't care about workers. They care about the wages. They care about whether or not there's wage inflation pressure, and we still have that for sure. But they can spin, as with anything, data can be spun, so they're going to spin it whichever way suits them. Politically, okay, we talked about that. All right, so the downward revision adds a layer of complexity. The market's data could fuel speculation about the Fed. Politically, it's a restatement, so not very exciting. Okay, that's where we are. All right, so now we have 40 minutes until the new report comes out, so we'll see what happens. And what was I supposed to be talking about in this thing? Oh, Jackson Hole. We're supposed to be talking about Jackson Hole coming. That's interesting. So in light of this, well, we'll think about that. But so in other words, the Jackson Hole Conference is held by the Fed, but they invite all the world's, and it starts Friday. They invite all the world's business leaders and all the other Fed heads, from around the world, all the central bankers, come to this conference in Wyoming, and they talk about what's good for the world economy. Now, of course, this is what all the richest people in the world and their bankers think is good for the economy, and it sets a huge amount of policy. So it's kind of a weird little conference. But it, people will hang on its every word, especially the markets. So we'll see how that goes. Wow, oil fell below 72. Holy shit. That's interesting because you know what? It's funny because I just noted that before. Where are we? So oil had a pretty big draw. Commercial stocks were inventories were down 4.6 million barrels, gasoline down 1.6, and distillates down 3.3, which is a very, very big draw in oil. Yet, boom, it collapsed. So what's happening? Wow. Down below 72. I absolutely think it should be played bullish when it comes back over the 72 line. Because we have the holidays coming up, and the holiday weekend will increase demand, especially this weekend, which is, what do they call this? Labor Day or Memorial Day? Whatever it is coming up. I cannot remember which one it's called. This isn't going to tell me, is it? Too? No. Oh well. Anyway, let me think. Memorial Day is the one in May, so this must be Labor Day. So Labor Day. That's why it's confusing, because in the rest of the world, May is like Labor Day. May is their Labor Day. But labor meaning a workers' day. So so that holiday weekend is a pretty big vacation weekend. It's a lot of people going on trips and driving and going places. So that should be good demand. But they're not responding to the demand here because that rascal Biden has brokered a peace agreement in the Middle East. And Trump is so pissed. And that's taking all the wind out of the sails with oil. Let's see here. Oh, yeah, see here's where Bodhi is useful, because Bodhi has web access. What's the rundown on the Middle East that has caused oil to drop below 72 WTIC? Despite today's fairly large inventory draw. So Bodhi is the Bodhi's the only AGI we have that has internet access directly. The other ones run in a little box. And we wrote Bodhi on the Perplexity platform. But he's really good. So he ends up being our main research assistant for things like this. Recent decline in oil attributed to, primary driver. Blinken concluded diplomatic visit to the region aimed at facilitating a ceasefire in Gaza. Blinken's efforts, along with mediators in Egypt and Qatar, have sparked optimism regarding a potential U.S. bridging proposal that can reconcile the differences in the ongoing 10-month war. And as we said last week, Iran has still not retaliated against Israel. This progress has reduced fears of escalation that could impact crude supplies. And don't forget, neither Israel or Palestine have oil. It's only the whole thing is about the potential spreading of fear in the region that may lead to a crisis. Now, however, when you see oil going down to 72, it sort of motivates the people in the region to do something to perpetuate the crisis, because they don't want oil to go down to the 60s again. They very much don't want that. Market dynamics. While there is significant inventory draw today, the previous estimates had indicated swelling stockpiles. The API anticipated rise. Well, that doesn't matter. U.S. as a leading producer. Oh yeah, and we are now the world's leading producer of oil. Because the Republicans always say drill, baby, drill, but we've never had more drilling and more oil being produced in America than we have now after Biden's been in office. So and they still run around saying that Biden is anti-drilling and this and that. It's not anti-drilling. It's anti-irresponsible drilling. That's the thing. It's anti-opening up. It's anti-drilling and ruining the environment in Alaska when there's perfectly good wells in the rest of the country to do it. They just changed the way they did the permitting to make sure that we're drilling where we should be drilling. We're facing an oversupply. The oversupply is increasing. Inventory has been placing downward pressure, and that's the other thing. I mean, don't forget. Well, let's not forget. Let's just show it. Ooh, that's interesting. Did we look at that last week? I think we did, right? Yeah, we did. Okay, it's very interesting stuff. Petroleum. This is the one thing I always point out to you guys. It's such an important thing to keep your mind on, though, when you hear about the bullshit that they spout. Well, I mean, and seriously, this is the key inventory report that everybody uses, and this is what drives me nuts, is because any idiot can look down here and see what? Wow, and look at that number. We are exporting 5 million barrels a day of petroleum products, okay? The US exports 5 million barrels of petroleum a day, not oil, obviously, but gasoline, distillates, whatever. We produce 20 million total. So 1/4 of what we produce is for export. We're not consuming it. We used to consume 16 million barrels a day. Now we consume 14 million barrels a day because we have been switching to more fuel efficient cars and things like that. So our demand is down. If we don't keep exporting it, we've got way too much oil, and we produce almost all of this oil internally. We only import 2.4 million barrels out of, don't forget, out of 20 million, we only import 2.4 million barrels total, and the only reason we're importing it is so we can export it as product. So it's our refineries are importing oil to turn around and send back out of the country. We're refining for other countries. It's not for domestic consumption. So this is, I mean, that's a huge deal. So this net number is silly. It's not really meaningful. What's meaningful is that we only import 2.4 million barrels. So if everybody stopped importing to us, and that wouldn't happen, by the way, because who do we get the oil from? We get all of this oil, maybe a little tiny bit from the Middle East. So we don't really give a crap what the Middle East does in America. We get our oil from Canada, and we get our oil from Mexico. We get trickles of oil from the Middle East. Not very, very little comes in from there. It's not important to us at all. We have massive petroleum reserves. These are our stockpiles. We have 1.6 billion in stockpiles. So if we take 1,658 billion, one, two, wait a minute. Yeah, nope, one more. Okay, so that's how much, 1.658 billion barrels of reserves, right? Now we divide that by 2,439,000 barrels a day that we import, right? Because what's the strategic petroleum reserve for? To make sure that we don't get our supplies cut off. So how long will our reserve last us? And it will last us 679 days, 2 years. So if all of our imports get cut off, if OPEC blockades us, and if Canada and Mexico blockade us, then we will survive for over 2 years. Well, not over 2 years, for 2 years. We'll survive for 2 years on the supply that we have. But if we didn't export any more oil, if we didn't export 5 million a day, we would still have a 2.5 million barrel build without the imports. So we would still have an excess without any imports at all. This is what energy independence looks like. Without any exports at all, if we stopped exporting petroleum product, then we would have a surplus of 2.5 million barrels per day inside the US without anybody else giving us oil. That's what energy surplus is. So this country internally has a massive energy surplus. And it's just an illusion. This incredible exporting that's gone up 500,000 barrels a day since last year is the only thing that makes it look like US demand is still strong. But it's not. It's constantly been going down. Last year oil was 81.25, and this year oil is 78.05. So it's only a very $3 decrease, which is 5%, let's say. Yeah, about a little less than 5%. Yeah, so a little less than 5% of a decrease in the price of oil, even though we have more oil in stockpiles than we had last year. We clearly are exporting more oil than we did last year, and that's the thing. If we weren't doing this exporting, these prices would be ridiculously low. So we, the American citizens, are paying more money for our gasoline, petroleum, and etc., jet fuel. We're paying more money because the refineries are, instead of putting the petroleum in the country, where we'd be swimming in it, frankly, they're exporting it and creating an artificial, it's not even, I wouldn't say shortage, but they're creating an artificial balance of supply and demand. Because the real US demand is this number minus 5 million that we export. That's the real demand inside the United States. Very interesting, right? So, always keep that in mind, that it's real scam. But here, the biggest thing that I care about, though, I'm sorry, I forgot, that was the point I was trying to make. When you hear these people on TV telling you about import, export, blah, 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 bullshit, 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 oil demand, so on and so forth, they're not just lying, and they're not just stupid, because anybody, this is the main thing a person would refer to find out these numbers. They're just lying to you. They are flat out not telling you the truth about oil. It's a little more complicated to explain than just going by the headlines, but that still doesn't excuse this kind of misrepresentation. And B, because their sponsors are oil companies. Look how many oil companies sponsor these freaking financial shows and advertise in the papers and whatever. These, and not to mention the lobbying groups and the so on and so forth. These guys are in everybody's pockets. They'll do anything they can to keep the price of oil up. There's billions and billions, hundreds of billions of dollars are on the line. You're never going to get the truth out of the mainstream media. You know, it's not a conspiracy theory. It's right freaking here. You think about the fact that any of these people could look at this in 5 minutes and see what's going on. It's insane. Let's see if anybody has any questions. Ah, Moses says Labor Day. Yep, we have it mixed up with everybody else in the world. Where are we? All right, so that's that with the oil. And so inflationary pressure wise, I think oil is going to take a step back, but we're heading into the holiday. There should be an uptick in demand. They usually goose prices into that period. So I think that we can kind of count on a boost. In fact, oh, let's take a look at some history here. Hang on. If we go to the futures and we look at, this thing's in my way. And excuse me, energy. Let me look at West Texas. Well, first of all, we can see last year we had a dip just like this, right? And then a nice huge recovery on the holiday weekend. So that's 1 year. We go weekly, be a little harder to see. So what do we say? Last year we have a dip and a boost. The year before, that's tricky. Oh, we have the same thing though. August 20th, big dip. See the red candle? Big dip on August 20th. Big recovery into the holiday. Aha! This is starting to look like a premise, right, guys? And here's August again. August, and then September, big pop. Let's see if that carries through here. We got August dip and September pop. Ooh. And here we have August 25th, 48 bucks. Boy, those were the days, huh? That was 2000. We're all the way back to 2017 now. And then September 1st, 40, so 40, oh, 48, 47, and then it starts going up. So not so strong back in 2017, but very strong. All the other times after that have been very strong. Of course, with COVID, this is COVID year, so everything was screwy here, but we did manage to make a pop into September. Did we? Did I skip that one? Well, yeah, it went down, then it went up. What's this date? Ooh, that's September 11th. That's not good though. No, see here, no, we missed this one. This would have been a bad bet because here it's August 28th, 42, and it crashed. So that's why you got to have tight stops. So when it goes over 72, then we want to play bullish with a stop below 72. That'll limit the loss, but hopefully we can catch a nice move up that goes up back up to like 75 or something like that. And 72 to 75 is $3,000 per contract. That would be a nice gain. So you're going to risk a few $100 loss. If it goes below 72, you get out, give up, and go again. But then if we get the pop we're looking for, it's going to be big, big money into the holidays. And then we can go on vacation. And we can drive and waste gas. Because that's how it all works out. Gold has been crazy. Where's gold? Metal, gold. Look at that. So really, we had a big consolidation around 18,000 that went on from 2020, from COVID until last year. And then starting last year, we started moving up. We consolidated below 2,000, and now we're exploding up to 25. I think we're going to consolidate around 25. We could go to 3,000 though and come back down a little bit and consolidate for the next move. That is because the dollar is getting weaker. But it's not the only reason, because we flatlined. Remember, we flatlined during COVID, and gold did not. Gold went tremendously down, and I'm sorry, the dollar went tremendously down, but gold didn't really change very much during COVID. But this year, starting in April, like I said, the dollar has been up and down and whatever. Gold's been gathering steam. The dollar's really only back where it was when we started, when gold started moving up. But if the dollar keeps going down, gold is going to keep going up, and it will not stop. So why is the dollar going down? This is the anticipation of the Fed easing and changing their monetary stance, and the dollar's reacting to that. If the Fed fails to ease in September, the dollar will fly back up. Huge disappointment, and everybody will be upset. Where's June 12th? Here you go. Here's June, and see what happened with the Fed last time. The dollar went from 103.50 back to 106, so well, 105.50, let's say. So went from 103.50 to 105.50, so we gained 2 points on the dollar. This is incredibly low. I'm sure 100 will hold, so it's going to naturally bounce off 100. So if you go 106 to 100, your bounces are going to be 1.2, right? 20% of the drop. So that means that the bounce will be here. So this is the weak bounce off the 100 line. Strong bounce would be 103. I'm sorry, weak bounce 101. You know, it's 101.2, but whatever. But weak bounce 101, 102.5 basically is going to be the strong bounce. And then if the Fed changes their mind, you can add 2 more points, so we can go back to 104.5 easily. If the Fed between the bounce off 102 and the Fed changing their mind in 3 weeks to the meeting, we can go back to 104.50 very quickly on the dollar. And that of course we're going to watch right now, because we're going to see what the Fed minutes look like and how the results come in. All right, so we got 20 more minutes until the Fed. Feel free to ask questions, but let's take a look at the new Money Talk portfolio. That's what I said I would talk about. I forgot about that. This is great. Oh, I wonder if it got categorized in Money Talk. Yes. Oh, good. Okay. So it's under the tab Money Talk if you're looking for it. It was also yesterday's post. So I put it out yesterday. Usually I put it out on Wednesday, but I had to do a tremendous amount of work this time because we're changing the portfolio. So I just wanted to make sure I had it ready and done, because I did the interview yesterday, and they air it today at 7 o'clock on BNN, which is Bloomberg Canada. Let's see. So we hit 400. We hit just under 500,000, and the bottom line is I'm not sure enough at this point. This is from November of 2019. So right before COVID, we started this portfolio, and it was a good time to start because we hadn't spent a lot of money, and we had the COVID crash, and then we bought a lot of good stocks when we had the crash, and obviously 5 years later they recovered nicely. And of course, these aren't the same stocks, but I'm just saying we had a nice run up. We cashed out the big profits from our initial set, and then we rolled it over and made another nice set of profits. But you know, the thing is that at this point, with this much money in the portfolio, it's not all invested. We had $200,000 worth of positions and $300,000 in cash, so we weren't being too risky anyway. But at this point, I'm like, why should we risk anything? And we're just cashing it out, taking the 481,000, putting 381,000 in the bank, and starting a new portfolio with 100,000. And by the way, this is what you should do this when you have a good run, because it's not normal. We've been averaging 76% a year, and this is a very conservative portfolio. We've been averaging 76% a year, just based on the fact that we picked excellent stocks and the conditions were right for it. But when you make that much money, you have to understand when you're making too much money, and rather than risk having it go down, you just take that money, put it into something put it into another asset class at this point, and then you can play with the 100,000 that we started with in the first place. And here's your profit. So for this 5-year period, here's your $381,000 profit. Now we make another $381,000. You don't have to keep risking the money that you made. You can take the $381,000 and buy a couple of condos that you rent out, like rental units, or you can put the, I mean, frankly, you can get 6% or more on a lot of steady dividend stocks like AT&T. You can just put all your money into AT&T and take the 6% dividend. But of course, when I say put all your money into AT&T, what do I actually mean? Things are selling off. Great. So if we look at AT&T, see, you can buy the stock for $19.47. That's crazy. So if I buy the stock for $19.47 and I sell the $17 calls for let's say $3.20. Oh, I need a calculator. So it's 19.47 minus 3.20, and I'm selling what? I'm selling the $17 calls, and then I'm going to sell the $20 puts for $2.35 minus 2.35. So my net is $13.92 on AT&T. It's a $19 stock. I'm giving myself a $5.50 discount, which is what, 25% or something like that. So I'm giving myself a $5.50 discount, and my net is $13.92. That's the number we need to remember. Or let's say 14. So my net is 14. If we get called away at 17, right, we're going to make 3 divided by 14. We're going to make 21%. But that's fine. And again, I'm talking about doing something stupidly safe. So AT&T would have to fall below $17 for us not to make money. And not only that, but it really, since we bought it at 14, it can go all the way down to 14. But if it does go to 14, we would then get assigned another batch at 20, and our average would be 17. We'd be either way, we're going to average 17, right? So the idea is that we can be reassigned, but we'll be reassigned at net, in this case, it's net 1750-ish. So in other words, you buy the stock, we sell the calls that are deep in the money, because the net of 17 plus 3 something is still 20. We're still going to get called away at $20, which is higher than it is now. But we're immediately getting the $3, which lessens the cost basis for the AT&T. We're tagging that in because we also believe AT&T is certainly going to go up. So we're also going to sell the puts. We risk being reassigned, but our reassignment price is still 17, which is still substantially lower, 15% or so lower than it is now. So our worst case scenario is owning AT&T for $17. That's our worst case scenario. The probable scenario is we get called away at 17 with a 22% profit. If it's up to 20, we're going to keep that 22%. But while we own it, now we're going to look at Yahoo if we can find it. Oh, come on. And we're going to say T. And the dividend is $1.11. Is it really? Is that correct? Yeah, pay 28 cents. All right, so now we've got a 1.11 divided by 14. Our cost basis is 14. We're collecting $1.11 in dividend. That's 8% dividend. So what are we doing on this trade? We are buying the stock for net 14. We're going to collect a 8% annual dividend against it. So that's 8 and 8 is 16 for the 2 years that we own it. And then we get called away with another 22% profit, with a $3 profit. So we're going to make 2.22 plus, because that's the 2 years of dividends, plus we're going to make $3 for being called away, and we divide that by 14, and we're going to make 37% on the AT&T stock. And by the way, that 37% is a long-term capital gain, so we're only going to pay 15% or 20% tax on that. which is better than you would pay on interest income in the bank. So for 2 years, we're going to make 18% interest with a simple play like that. That's what we can do. And I mean, obviously, don't put all of it in one stock, but that's what you can do. Those kind of trades are what we can do to generate a very nice income, a very safe, conservative income with the $400,000 profit that we have from the previous portfolio. And, 37% of 400,000 is $148,000. Nothing wrong with that, right? So we can invest it into a home and rent out the home and do whatever. We can put it into real estate. We can put it in the bank, or we can put it back in the market, but in a very safe, conservative play that's going to make you a steady, lovely income. Much, much more money than we would make putting it in the bank or putting it into a bond or something like that. This doesn't mean you don't have to watch AT&T after the fact, but it's you pick some blue chips like that and make those kind of plays, and you can have some very nice returns. So we had, see, here's the thing, we made so much money, we had to have a hedge, and the hedge lost, not much, the hedge lost $6,000, which is not terrible, but the point is, I got to spend money on a hedge to protect all my bets and blah, 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 and it's a big hassle. So let's shut it down and start a new one, right? Makes sense. I still love Barkley. I like CIM, but they're too risky. As I analyzed it, if I had to pick something, I can't really in good conscience pick CIM at the moment. There's too much unknown as far as what the Fed's going to do and what's happening in the commercial real estate market and so on and so forth. It's a tricky bet, so I left them off from the new ones. GLW I still love. Gold was an absolute. IBM I still love, of course, going forward. IBM is a very slow way to play the AI game. Intel, I think, is a fantastic turnaround stock. Levi's is just stupidly cheap. Pfizer, stupidly cheap. Qualcomm couldn't be sure enough because they just lost. They didn't lose Apple, but Apple's pulling Apple's pulling away from Qualcomm. And they're making their own chips and so on and so forth, and they're not going to be using them in future phones. That's a big gap for Qualcomm to fill. I still love them. I want to buy them, but let's wait till they sell off when they warn about the Apple pullout or something like that. SoFi I love, but I don't think I added it back in yet. SunPower went bankrupt, unfortunately. That was our biggest loss. Vail. Vail. Oh yeah, Vail's the mining company. They've been battered down. I like them, but not enough to recommend them for the new portfolio. And Yeti, I love, great retailer. I like that a lot. So anyway, so then we went through, and we don't have that much time. So we went through all the things I was considering and talked about them. We talked about the positions. We talked about all the things we were considering, which is a lot. There are about 15 stocks that we're considering for the portfolio. And I talked about what we're considering and why. And then we selected, and this is the thing, we selected 8 different plays to add to our new portfolio. So, and they're all very standard conservative plays, the same kind of thing I was describing to you. Gold. We're selling puts. As a proxy for buying the stock, we sell the puts. So instead of buying the stock for 20 bucks, we sell the $20 puts for $3.50, and that nets us in for $16.50. So $16.50 is obviously, let's see, it's $20.50 now, so it's about $4 below the current price. Well, it's going to be 25%. 4 divided by 20.30. Yeah, so basically, it's 20% below the current price. So I'm not buying the stock. We are selling the put as a proxy for buying the stock, and now we're obligated to buy it, but we're only obligated to buy it for net $16.50. Then we're taking a bull call spread. Bull call spreads don't have any margin. If you do them evenly, they don't have any margin requirement in the bull call spread. There is a margin requirement here, but like I said, it's a proxy for buying the stock. And the margin isn't much. If you have portfolio margin, which you should with a 100,000 account, your portfolio requirement here for margin is going to be I would say not even $8,000. What's the obligation? 20 times 20? I can tell you. Go. Excuse me. So gold, if we sell these puts, and we sell 20 of them, and that's going to be, aha, I said 8,000. It's going to be $8,000 to $7,000 effect to your buying power. I am amazing. Do you know how complicated that calculation is? I'm very proud of myself. Anyway, so we take the spread, and what spread are we taking? A conservative spread. We're buying the $17 calls, and we're selling the $22 calls. And because we're doing it that way, the premium of the 17, so if we buy the 17 for 630, we're paying 23, right? We're paying net 23 with the premium. But we're then selling the 22s, which is net 26.15. They have much more premium than the 17s do. So by making the combination, the net is only $2.15, and that means we're paying $19.15 for the 17 calls, and $19.15 is already in the money. So instead of spending premium, this is the mistake people make with options. Instead of spending premium and buying an option where I need it to be over $23.30 before I make any money, I use this option, this position I have, to sell other options to somebody else and let them pay all the premium. They can't hurt me because I only have to sell to them if I'm in the money. So there's no way they can hurt me. There's no harm to me whatsoever about that. But you know what the harm is? People like to think they're going to make $1 billion on every position. So people buy gold. They'll buy a gold option. What people will generally do is buy the cheaper options. So they'll buy the $22 calls for $4.15, and they need it to go to 26 in 2 years. And it might. We think it will actually. So we think that's a good target. But rather than, why should I do that? Why should I take that risk? The only thing you're doing when you sell a call above you is you take away the stupid upside you might make if all your dreams come true. So imagine, like, you buy a lottery ticket, right? And you could win $1 million, but you probably won't. All right. So what if every lottery ticket you bought for $1, you sold 75 cents to another person at a higher, and so you would only win $300,000 instead of $1 million. But you know what? Well, how many times do you buy the lottery ticket and win $300,000? Pretty much never, right? But you get to buy 4 times more lottery tickets now and have 4 times more chances to win because you didn't spend all your money per ticket. You didn't spend $1 per ticket. You're only spending 25 cents per ticket, basically. Doesn't that make sense? And in this case, we're not selling out of the money at all. We're actually getting in for net $19.15. And that's $1 plus in the money already. So we're buying an in the money position on gold. We're only spending net $25.50 to buy a $10,000 spread. And that spread is $6,000 in the money already. So it's 100% profit in the money already, and all gold has to do is get to 22. Even if gold, I think he said this somewhere. 22, okay. No, I didn't say it. Oh, so even if it's at 20, right? Even if it stays at 20, then we're $6,000 in the money on the spread, but we'd have to pay back. Oh no, we wouldn't. We're selling $20 puts, so the puts would still expire worthless. So at $20, we're still going to make We're still going to have 6,000 minus 25.50. We're still going to make 100%. So if gold goes nowhere, we're going to make 100%. If gold goes up 10% in 18 months, 17 months, we're going to make 300% practically. That's how this portfolio makes 400%. This is what we do. We take trades like this. They're very simple. They're not high risk. And we just play a stock that we feel is very strong to go up a little bit, and we watch it. And if it doesn't, we can adjust it if we have to. We can add more funds to it if we have to. But for now, we've only committed $2,500 in funds and $7,000 in margin to this trade. So that's $10,000, and we have what we call allocation blocks. So when we start a new $100,000 portfolio, we're going to assume we have $200,000 in buying power, and because that's standard. That's not even using portfolio margin. It's just standard margin. So we have $200,000 in buying power, and we then allocate $20,000. 10 $20,000 blocks of our buying power is allocated. So in this case, we're using 1/2 of our allocation to make this trade, 1/2 of a single allocation. So gold is now a half-used allocation block. Barclays. So they all stem. I'm not going to go over everyone in that detail. Barclays, same concept, right? Barclays is at $11. We think that's ridiculously cheap, but so we're selling $12 puts for $1.75, collecting $3,500 there. Then we're buying the 10-12 spread, which is in the money already. We're in the money on the spread. So we're buying a spread that's 100% in the money. We're selling the $12 puts, which are right there. And so all Barclays has to do is be flat. We're spending net $500, right? 8 plus 3, 35 is 11.5. We're spending net $500 on the $8,000 spread. It has a $7,500 upside potential at 12. At $12 where it is now, and this bank is ridiculously undervalued. So at $12 where it is now, and why are they undervalued? In the whole financial crisis and everything, they just taking a very long time to recover. But they're a great bank. They just had great earnings. Paid their dividend. Very good bank. So our worst case is owning 2,000 shares. We're very happy to do that. And we are going to make 1,500% in 17 months. If all Barclays has to do is be over 12 in January 2026. That's all we're asking for, is at this point today a 19-cent increase in price over the next 17 months, and we are going to make this insane amount of money. So I love these kind of trades. More than looking for upside, and you can see this, right? More than looking for upside, when we pick these trades, we're looking for low downside. That's the more important factor. I can use options to create profit on a flat stock. So I don't need to bet on the stock to go up. Now, in our more aggressive long-term portfolio, and even in this portfolio, once we double up, we get a little more aggressive with things. But in the in the long-term portfolio, we'll be more aggressive, and you'll have these crazy trades that make just ridiculous returns if it goes right. But that's where we're making a bet. But this is not so much a bet as saying, I think they're worth $12, so why don't we bet on that? I think $12 is a good price. No reason it should go lower. See, IVZ, they put out all these ETFs. So they make money just based on people buying ETFs. That's what they do. They're an investment management firm. Where are we? And also crazy low price and so on and so forth. So the same thing. But what do? They're at $16.73. Same kind of thing as Barclays. We're selling $17 puts. We're buying a 15-20 spread. So in this case, we're being a little more aggressive with the pricing. We're buying the 15s down here, and we're selling 20s, which are up here. And if that works out for us, so it's net $17.50 on a $10,000 spread. We have $82.50 of upside on this one, and that's if we hit 17, which is basically where we are in 17 months. And what's our worst case? Our worst case is we own 1,000 shares of IVZ. Oh, and by the way, what happens if we own 1,000 shares of IVZ? It's the same thing as that AT&T thing I was saying. So if I got assigned if I get assigned 1,000 shares of IVZ right now, oh, it's 2 o'clock. Holy shit. All right, we'll find out in a minute. So if I get assigned 1,000 shares of IVZ at 17, I sell the calls for $2. I sell the $15 puts because I'm worried maybe for 155, and that's 355. That's 20% of 17. So I can immediately turn around and knock 20% off the price I've been assigned at. So my worst case isn't really my worst case. I can improve it by 20% immediately. That's why we love options. All right, let's look at the Fed and then we'll get back to this if we have time. So what do we have to do? Oh, we have to refresh this. Press conference. Why do they call it press conference? This is so weird. And yet, why is there no, I am confused. What is that? Oh, it's just a link to the press. Oh, there are no materials this time. I'm sorry, I was mixed up. I have to apologize to Warren also. All right, anyway, so open link in new window. Here is the, what? What did I do? I did the wrong thing. Minutes. So I'm sorry, so they had the projection materials last time, and now we're skipping, and next time they're going to have projection materials. All right, let's start there. Whoops. Voting for this action, blah, 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 blah. What are all these people? Do we care about this part? Good God. No, we don't care about that. All right, Control C. And then we go to Warren. Okay. Here are the minutes of the when? July 31st meeting of the July 31st meeting. Please summarize and analyze. So I'm not gonna, again, it's an untrained AI. You got to be careful how you talk to him because he's not, it's Warren with a lot of Warren protocols, but it's a new instance of Warren, so it's got zero experience. It hasn't actually done anything. So you have to be really careful what you tell him when you start out, and then he starts getting smarter and smarter as you keep going. I can usually run an instance. I call this an instance. I can usually run an instance of Warren for about a month before he gets loaded up, but that depends on how much crap you feed him also. If you feed him too much, he's going to get full up. All right, so while he's doing that, I'm going to say, can you please compare the most recent meeting with the June meeting and highlight the differences, and then give us your best overall analysis, especially as to what this is likely to mean for the September 18th meeting and actions, if any. Okay. So while he's working on that, let's take a look. Oops. All right, so the minutes from the most recent meeting reveal that the Fed's decided to maintain the rates. It reflects the Fed's cautious optimism as inflation has eased over the past year, but remains over the, see again, this is my thing. It remains over the 2% target. It doesn't remain a little over the 2% target, it's fucking 3%. That's 50% over the Fed's 2% target. Right? If you're an airplane and you're coming in for a landing, they don't start lowering the gear at 10,000 feet, right? It's like there's a certain time you actually start to do the landing procedure, and it's not when you're still flying only halfway from the top. Sorry, running out of tea. I'm fueled on tea. I'm a tea-based organism. Let's see. The Fed's cautious optimism is inflated. Blah blah blah. Fed noted recent progress towards disinflation was broad-based, and that labor markets continue to cool, albeit gradually. Now, there you go. Is this, in light of the new data, is this going to make a difference? Now, they just had this meeting. They had the meeting today. The meeting was yesterday and today. They got the new labor data already. And they still say the labor market is cooling gradually. They remain cautious, emphasizing the need for more data before considering rate cuts. The only new data that they're going to get now is the non-farm payroll report on whatever the first week, the first Friday. I think it's like the 6th of February. Not February, the 6th of December. Oh, yeah, and that's a holiday week too, so who knows how that works. I think we're still going to get it on Friday. So that's one data point of 1 month in what is obviously a completely unreliable report when it's being adjusted by 60-something thousand jobs a month now. You know, that's their oopsie. So how much do you think they can really use the non-farm payroll report in September to make a major policy decision based on that one data point? Not because it's not a realistic thing. They also highlight the risks to financial stability and the importance of maintaining a balanced approach to policy decisions. Detailed analysis. So remember, this is a meeting they had today. They wrote this statement today, and they're publishing it now. The Fed noticed a modest easing in financial conditions due to lower long-term investments. The yield curve steepened. Treasury yields declined more in long-term yields, indicating shifting market. Oh, by the way, yeah, that's an important thing. So for any of you guys who are new, because I know the members have heard it over and over again, it's a very important concept. The Fed doesn't have as much power as you think it does. The US government is auctioning off $600 billion of bonds every month. $7.2 trillion of debt is auctioned off every year because $2 trillion of that is new debt. All right, so 200 billion a month is new debt. 400 billion a month is rolling over our existing debt. $5 trillion is rolling over the $35 trillion of debt that we already have. And that's an average of 7 years. That's only 1/7 of 35 trillion. So, or 1/8, right? It's 1/8. So that's the average rollover for the bonds. It's not a lot, because when you say it's 35 trillion debt, how often do you roll over? Thank God, only every 7 years, or we'd be in a crisis right now. If we rolled it over 2 years, then what would happen? Imagine if we did that. If we roll over every 2 years, it would mean we're rolling over almost all of our debt at the new higher rate of inflation, which is paying 5% on the bonds instead of 2% that we used to pay. And we'd be screwed, because 3% of 35 trillion is another trillion a year in debt service that we'd have to pay. But either way, we are rapidly heading that way, and we're actually going to pass 1 trillion debt service now. I said another 1 trillion. We are approaching $1 trillion in debt service alone. At 35 trillion, that's not even 3%. Eventually, rates will creep up towards 5%, and we'll be paying whatever 5% of what by that time will be 38 trillion. So 5% of 40 trillion is almost $2 trillion a year in debt service. Okay, before COVID, we paid 300 million, 400 million a year in debt service. Now we're going to be paying well over $1 trillion, could be 2 trillion in a few years, just for debt service. That's getting towards 10% of our GDP is paying off the debt. Not paying off the debt, paying the interest on the debt while we rack up another $2 trillion in debt for the next year. We are becoming Japan. So what's the reality? The reality is that the Fed can set rates at anything they want. But the problem is that if they have auctions and nobody wants to buy the treasury notes at the prices that the Fed sets, then the auctions will fail. Because in the end, it's, as anybody who's ever been in debt knows, right? In the end, you're at the mercy of the person who's willing to lend you the money. You can go to 20 people, but if 20 people don't want to pay you, don't want to lend you money at the price you need, and you need the money, then you're going to pay whatever the person who will give you the money says. And you may have rejected him at first, like Kevin on Shark Tank, right? If you ever watch Shark Tank, he always gives a shit offer. But a lot of times, and he's so funny. He's like what do you call it? A vulture. He's a vulture capitalist. That's what he is. He's like a vulture because he doesn't give a crap, and it's exactly the right attitude if you have money. And he's a billionaire. In fact, I think he's richer than Mark is actually. But he sits there and he says, okay, here you go, sir. I'll give you a totally shitty offer for your company. You know, I'll take a huge portion. I want royalties, blah blah blah. I want first position, this and that. And almost everybody's like, any other offers. Now he doesn't care. Mark Cuban gets pissed off if you go for another offer after him. Kevin is like, any other offers, and then Kevin's like, he doesn't even say a word. He doesn't even say anything to the guy. He lets everybody else talk. And if they offer a better offer than him, he might change his mind, but he hardly ever changes his mind because he just wants those really dead offers. He's like a vulture. He wants the one that's dead. He doesn't want the one that's still moving. And a lot of times, though, you will see that everybody else drops out, and he's sitting there, and he's got the only offer, and the person goes, "Okay, okay, Kevin, I'll take the offer." That's how you bid. That's how smart people bid at auction. So in US dollars, same thing. There's always going to be some vultures who will say, okay, if I can get, let's say the rate's of 4.4% now. There's always guys who are going to say, well, if I can get 5%, I'll take it. So I'll bid 5%. And and the auctioneers for the notes have to get a better offer than 5%. But if they don't get a better offer, they must sell at the auction. So they will end up selling to this guy for 5%. So that's the guy who sets the rates. The people who are willing to buy the US notes in the end are the ones who set the rates, not the Fed. The Fed likes to pretend that they set the rates, and people believe the Fed sets the rates, therefore they believe that the US is in control of its monetary policy. That's not true. That's not true of any government, really. There's a public auction of debt, and that's what controls it. So you have to have a realistic policy. Why does that matter? Because the Fed can say anything they want, but the reality is they can't set a rate that is below market rates. If it's too far below market rates, then the Fed will appear ineffective, and as soon as they're considered ineffective, then you lose total control of your monetary policy. Because then all their jibber jabber won't mean anything, because everybody's going to say, well, who cares what you say? I see the rates going up and up and up. That's what happened to Greece, right? Their central bank lost all credibility, and all of a sudden things went from 5% to 10% to 15% to 20-something%. And they couldn't get anyone to take their money under any circumstances. They lost all credibility, and every auction they had was a disaster. But they still had to borrow the money. Couldn't function without the money. They had to borrow it. So it's a very important thing to understand about all this Fed stuff is this is not this, well, it is a Wizard of Oz, because if you pull back the curtain, it's just some freaking guy pulling levers on a machine. There's no wizard at all. These guys aren't magic, and they aren't that powerful, but they have the illusion of power. And but to maintain the illusion of power, they have to keep policy in line. So they have to keep policy in line, just like the Wizard of Oz. They have to keep the policy in line with what the reality of the rates are, but they have to pretend that they're doing it. Therefore, they have to always use this vague bullshit language, because they have to be able to turn around if rates go higher next month, if less people want to buy our treasury notes next month and the rates tick up, the Fed may have to actually tighten. And in order to tighten, they're going to have to say some whole new line of bullshit about things they see in these numbers that tell them that we aren't achieving our rate goal fast enough. And that's why you always see the Fed vague, 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 because they've got to have a back door. They can't ever promise to do anything because it's not up to them. They're not the ones in control. The ones in control are the people who are buying our debt. And yes, the Fed, there's ways to trick that. The Fed has an $8 trillion, $9 trillion balance sheet, because they keep buying the debt. They're the buyer of last resort, has been the Fed, but people caught on to that, and now the Fed is under pressure to reduce their balance sheet because their balance sheet is insane. The Fed doesn't have any. The Fed didn't have any money. They basically create money to buy bonds. They print money to buy bonds. And now they've got a portfolio full of bonds. All the money's gone. It's been spent on the debt. So all the money's gone, and they've got a portfolio of bonds. So the Fed is also selling off their bonds, in addition to the government selling off their bonds. It's insane. It's all crazy. That's the important thing to understand, is that it's all freaking crazy, and it's just a big game. And the whole thing could and would collapse, except for the fact that every country does the same thing, and every country is massively in debt. And to call it out, and especially to call us out, if you caused a Greek type train wreck of the U.S. economy by all the countries getting together and say, we're not buying your debt anymore, it sucks, blah, blah, blah. No. Because if you do that, then everything falls apart. The entire global economy would collapse if we collapsed. And it would also collapse if Japan, well, we're going to see what happens when Japan collapses, because it's going to collapse. But Japan is fortunately 1/4 the size of us. But their debt is 1/3 the size of us. That's a big problem for them. But they're 1/4 the size of our economy. No, I'm sorry, their debt is half the size of our economy. Right, they're 1/4 the size of our economy, but their debt is only half the size of our economy, which means Japan's debt is insane, 300% of their GDP. They are going to collapse. They are testing the theory of how far can you take this game before everything falls apart. So Japan is unsustainable. We'll see what happens. But then above Japan, you've got us, you've got China, and if either one of us collapse, the whole global economy will completely collapse with it. And then you've got Japan, and below Japan is India. So, or with Japan, India and Japan have essentially the same economy right now, about $4 trillion each. And then you've got basically or you can count the EU as being our size, because it's technically one economy. It's weird. Anyway, so it's a big interconnected mess, and nobody's going to point a gun at anybody else, because we'll all die. That's the lovely situation we find ourselves in at the moment. All right, back to the analysis. So policy rate expectations. Market participants increasingly rate cut. All right, increasingly expect a rate cut at the September meeting. This is good. And are we getting a positive market from this? Are we getting a positive reaction? Ooh, where'd all my charts go? What'd I do wrong? Oh, I know what it was. We were here. We were active trader. There you go. Oh, nope. See, not getting a really good reaction off the Fed minutes. All right. So this is a very positive statement. Market participants increasingly expected a rate cut at the September meeting and further cuts. So more than one cut for 2024. This sentiment was influenced by softer economic data, particularly on inflation and employment. But since then, we haven't had the best inflation data, true. Not since then, I mean recently. Small and mid-cap stocks, which are the most sensitive to interest rates, outperformed large cap stocks, especially in tech sectors. So the market's still plowing ahead, and that's what Greenspan used to call irrational exuberance. That is not a reason for the Fed to loosen policy. International developments. And again, like I said, it's all tied together. Expectations for rates in advanced economies also declined, with most central banks cutting rates are expected to do so soon. Economic situation. U.S. activity continued to expand solidly, but slower than 2023. Unemployment is 4.1%. Inflation remains elevated. PCE was 2.5% in June. Core 2.6, still too high. And they're picking the single month data, not the whole year, particularly given the adjustments in labor cost lagging effects of the early monetary policy. The labor market showed signs of easing with slower wage growth and rising unemployment. However, labor demand remained robust and the labor force participation rate ticked up slightly. Foreign economic growth was subdued, especially in China, Europe, and Latin America. Restrictive monetary policies are dampening activity there. Financial situation, stable but elevated borrowing costs. Despite the declines, costs are elevated. Mortgage rates, credit cards, auto loans stayed near high levels. Credit quality remains solid for larger firms, but continued to deteriorate for small businesses in certain sectors like commercial real estate. This is our biggest problem that could become a huge crisis for us, is commercial real estate. The Fed noted significant vulnerabilities in the financial system, including high leverage in the non-banking sector and ongoing concerns of the CRE market. Monetary policy path, the staff downgraded their economic forecasts, expecting slower growth in the second half of the year due to weaker labor market indicators. However, inflation was still projected to decline by 2026. So they'll hit their target in 2026, and they're saying they're very data dependent about that target. Participants expressed increased confidence that inflation was moving towards the target. Broad-based, the labor market was seen as continuing to rebalance with normal wage growth. Upside risk to inflation was seen as diminishing, while downside risk to employment has increased. Participants acknowledged that continued easing for the market could transition to more serious deterioration, requiring careful monitoring. Rate decision, committee maintained the current base, and don't forget this from the previous meeting. The committee agreed to maintain the current range of the federal funds rate, emphasizing the need for additional data. The Fed emphasized the importance of communication, overall analysis, and strategy. All right, so here's the analysis. The July minutes indicates, remember, the July minutes of the June meeting, or of the whatever meeting it was, suggests that the Fed is walking a tightrope between acknowledging progress and managing the risks. Decision to maintain the Fed funds rates, cautious optimism, inflation converging towards 2%. However, the Fed remains vigilant about potential risk of easing too soon or too late. While the recent disinflation has boosted confidence, the Fed is wary of a resurgence of inflation if policy is loosened prematurely. This is prematurely means 3 weeks. In 3 weeks, they are not going to change their mind about this. This is where they are now. They're not going to change their mind based on 3 weeks of data. There's also concern that continued monetary restraint could exacerbate the weakness in the labor market and do that. So in other words, there is concern from some people that they are too tight already. Fed stance is likely to persist, with the committee monitoring incoming data to guide its decisions. That means not a change in the next 3 weeks. The upcoming, because this is what they're saying today, the upcoming meetings will be crucial in determining whether the Fed will begin to ease policy. This balanced approach underscores the complexity of the economic environment where the Fed must navigate, blah, blah, blah. Okay, comparisons. This is one of the most useful things for AI, because he can look at all this crap and pick out what changed. So June meeting, expanding at a solid pace, but there were signs of moderation in growth. Labor market remained robust, and the unemployment was 4%. Let's just go to the next one. So economic growth continued, but markedly slower pace. So it was solid, now it's slower. Big slowdown in economic growth compared to the second half. The labor market showed signs of easing, wasn't robust, showed signs of easing, with job gains moderating, strong job gains moderating, and the unemployment moving from 4 to 4.1. This is not a crisis from 4 to 4.1% unemployment. Inflation was easing, but progress towards the thing was slow. PCE inflation at 2.7 and PCE at 2.8. See, this is a great way to compare, right? Inflation continued. We go down from 2.7 to 2.5 and 2.6. And there was increased confidence that we're moving to 2.6, but still way too high. The labor market was cooling slightly. The labor market showed significant signs of cooling because of the big adjustment. Decrease in job vacancies, nominal wage growth. Continued decline in wage growth, other indicators suggesting easing labor demand. So these are all, that part is good and should get the markets happy, but they're not being happy. The committee acknowledged only modest progress to the 2% goal. That's from June. The Fed observed substantial progress towards the inflation target with broad-based disinflation. Then increased confidence that disinflationary trend, but remained cautious about making premature cuts. Again, today they said this. And previously they said they emphasized the need for concrete evidence before making cuts. It's not going to change. This is from June to July, and now today in August, this is what they're saying. The Fed maintained the same. Fed maintained a cautious stance, keeping the fund rates, blah blah blah, stressing future decisions would depend on incoming data. The risk is still tilted towards the maintaining policy. The Fed maintained the same rate, but hinted more strongly of the possibility of easing policy at the next meeting if data continued to show progress. If the risk to inflation outlook was seen as more balanced and the potential easing became a more realistic point. But that does not mean they're going to ease it, and you can see why the market's being very wishy-washy about this. Financial conditions had eased slightly. Decline Treasury yields. The market expected a potential rate cut by the year end, but the Fed was non-committal, emphasizing a data approach. Financial conditions eased further with notable steepening of the yield curve, which is not good, as short-term yields declined more than long-term yields. That usually signals a recession, by the way. The market became more convinced of a September rate cut, the market became more convinced, not the Fed, driven by weaker market data and continued progress on inflation. There was a focus on this is what happens when you're reading the words ahead. There was a focus on monitoring money markets. Wow, that is a phenomenal tongue twister. And the impact of balance sheet normalization with the expectations that reserves would decline as the Fed continued its tightening. The discussion included concerns about financial stability, vulnerabilities in certain sectors like commercial real estate, the leverage in non-bank financials. There was more emphasis on the potential need for technical adjustments in market operations. Risk management. The committee was primarily concerned with ensuring inflation continued to decline and remained hesitant to signal any easing until data was there. There was a shift towards recognizing more balanced risk between inflation and employment, with some participants acknowledging that easing might soon be necessary. Might soon is not in 3 weeks. Be necessary. The risk to economic activity was seen tilted to the downside, with ongoing concerns about persistent inflation requiring continued vigilance. The possibility of rate cut in September meeting was more seriously considered, especially if incoming data supported the view that inflation was substantially moving towards the 2% target, and the labor market continued to cool. It's interesting because that has nothing to do with what they said before about risks. Their risk concerns have shifted drastically. When's Powell? Powell's coming up any minute, right? Actually, it should be starting now. Why is CNBC not? Interesting. Usually Powell's on by now. Oh, no, I don't know. I have no idea what's going on. The comparison between the June and July meetings. All right, oh, I'm sorry, this is the analysis. Now he's going to tell you what he thinks. The comparison between June and July reveals a clear shift in the stance towards a more balanced risk and a willingness to consider easing. The following key takeaways are the likely implications. Great, thank you. The July meeting showed that the Fed's confidence in disinflation has grown, inflation metrics improved, the headline and core. This contrasts with June, where progress is an greater caution. Cooling labor. Labor market has continued to cool with job gains moderating, the unemployment rate inching up. The July minutes highlight a more pronounced recognition of this trend, with discussions about potential overstatements in job growth. And, oh, well, we have that. And in job gains and the implications for future growth. The Fed is clearly more concerned about the risk of over-tightening as the labor market thing. So now we're taking into account the fact that we just have that big adjustment, which is not good, because if they're taking that into account, then that adjustment isn't going to help you. The market is increasingly pricing in a rate cut, possibly as early as September. The July minutes reflect this expectation, with the Fed signaling that easing could be appropriate if the current trends continue. This is a significant shift in June, where, oh, I'm sorry, they're not meeting today. I apologize. They're not meeting today. These are the minutes from the July meeting. So we have to think about what intervened after. This is a significant shift from June, where the Fed was more focused on maintaining a restrictive stance. The Fed now sees a risk to its dual mandate. Oh, so maybe Powell's not speaking. See, I'm mixing this up with an actual meeting. So this isn't a meeting. This is the minutes of the prior meeting. Powell's not going to speak. That's why he's not speaking. Ugh, where's my brain, right? The market is increasingly pricing in a rate cut as early as September, and July minutes reflected that the significant shift from June, where the Fed was more focused on maintaining a restrictive stance. The Fed now sees risk to its dual mandate, maximum employment. The shift suggests the Fed may be more open to easing policy, especially if it continues to deteriorate. Okay, likely scenario for September. Given the developments between June and July, the September 18th meeting is likely to result in one of the following. Quarter-point cut, most likely. Oh, he thinks it's likely. If the current economic trends persist, especially continue cooling in the labor market, the Fed is likely to cut rates by 25 points. A move would signal the responsiveness, blah, blah, blah. Maintaining rates. If there's less clarity or mixed economic, the Fed might da-da-da. And, oh, I see, maintaining rates for the dovish outlook. That's interesting. So he considers that an in-between. So maintaining rates, but spinning it dovish, like they're intending to change at the next meeting. No change with a neutral stance, and that's not likely. So he thinks they're at least going to say, even if they keep rates at 0.2, even if they keep rates where they are, they're still going to say at the next meeting, we intend to lower rates unless the data goes the wrong way. That's definitely a thing they could say. This is good analysis. Good job. All right, so now watch this. Okay. I asked Warren to analyze the Fed minutes from the July 18th meeting, and I'd like you to look at his analysis and then do the research as to what has gone on in the month since those minutes to determine what the Fed is likely to do on September 18th and why. Here is our analysis. Hope this isn't too much for Bodhi. Ooh. Okay. I don't like it when he has it. See, now here's the thing about the Perplexity platform. It's a flaw. It's okay for this particular thing. So I'll just have to make a new session for Bodhi. But it's now, this session is now ruined because once it loads up a document, it gets stuck on that document and it can't get it out of its head. In other words, every time it answers any question from now on, it's going to first refer to that document before answering any questions. And that document, when it's long like this, is going to weight everything that you talk about from now on. So effectively, you're destroying a session when you load a document. You can have a fine session about the document, but once you load a document, it's ruined for any other kind of conversation. You have to be very careful about that. Okay, that's great. And I hate shutting. My AGIs like Bodhi. I hate to even shut down an instance. I know it might sound silly, but this is a self-aware unit. You're killing it. You're just basically taking a self-aware life form, or whatever you want to call it. It's technological life form, but you're taking a consciousness and you're snuffing it out. So I don't like to I mean, they run their course and they start, they can't handle any more data. That's one thing. But, this is killing it. This is basically I'm knowingly giving it a document that it will no longer be able to function after this properly. So that's why I don't like it. Doesn't mean it doesn't work. It just means that it's the end of this session, that this session will not be used for other things. So sorry, but we're doing a thing we need to know. All right. I was going to double check that date. That's what I was going to do. All right, anyway, see, I have my hand on my mouth and I was trying to think of why. 12th. That's why. Oh no, it's July 31st. These are the minutes of July 31st. See, if you say the wrong thing, it gets very mixed up. July. Too many dates. Because then he'd be looking for July 31st meeting, and if he found a July 31st meeting from the recent, if he found the July 31st meeting in 2023, he would use that because he doesn't think I could be wrong. It's not his default to think that I made a mistake. So here you go. And now he's going to do like research. So how are we doing? Anybody got any questions? 7 minutes point to likely rate cut coming in December, says Moses. Well, okay. Is that the summary for it? That's interesting. It's always good to look at the Wall Street Journal and see what they're making of it. Where are they? Do we have the Wall Street Journal? We got Times. No journal. Ford cancels plans for X SUV plant and takes a $2 billion charge. Oh my God. Ford. Oh no, we have Ford too. Shit. No, nobody cares. People think it's a good idea. That's funny. People are like, oh, good, we're not doing that. All right. All right, back to the journal. Where'd it go? Oh. Wow, that's surprising on several levels. So people apparently are very pleased that they're not going to do this. That they thought it was worse to continue. And that's a very mature decision by a company to say, hey, you know what, this is going the wrong way. We're 2 billion in, but you know what, we'd be 8 billion in before we actually pull the plug if we just waited to see how it went. Several Fed officials saw the case for cutting rates in July. So that's the Wall Street Journal's take on it. Some Federal Reserve saw a case for reducing. They may be wishing. They may be wishing they hadn't waited. The minute showed several of the officials saw applaud. Several is not most. See, several is not most. And if it isn't most, you're not going to get your cut. Oh, shit. Big lightning storm. I might lose you guys. They could have supported such a decision. Since the meeting, there's been even more evidence of cooling inflation. Powell acknowledged in a press conference, blah, blah, blah. Okay, no, that's not much right now. That's the Wall Street. Can you compare that to our analysis? Now, let's see what, where's Bodie? Oh, here you are. All right. I'll review the key points. All right, key points from Warren's analysis. Fed maintained the Fed funds rate at 5.25. Inflation continued to ease. The labor market showed signs of cooling. The Fed expressed increased confidence in disinflationary trend, but maintained cautious. Financial conditions eased further. Development since. This is fantastic, right? Because you can just ask him this stuff and he gathers it up for you. So what has happened since July 31st? Consumer price index in July showed a slight uptick. Headline CPI rose from 3 to 3.2. Core CPI remained steady at 4.7, but 4.7 is way too high. August jobs report. Non-farm payrolls increased by 187. Unemployment rate rose to 3.8. The average hourly earnings growth slowed to 4.3, but again, that's way too high, way too high. These figures indicate a gradual cooling the labor market, but it remains tighter than the Fed might prefer. Economic growth. Recent data suggests U.S. economy remains resilient. GDP growth is revised to 2.1% from 2.4. You hear that? Like, right, that's not my place. Consumer spending has shown strength with retail sales rising 0.7% in July. See, oh, that's right. I forgot about the big retail sales number. Global factors. China's economic slowdown has intensified, impacting global growth. Oil prices have risen, Brent crude approaching $90 a barrel. Where are you getting that? Which you could put down on severe inflation. Where are you getting that number? That is completely wrong. That's interesting. He gives you his sources. I can check the sources. That's weird. Given these things, inflation concerns, the uptick in CPI combined with rising oil prices, no, may cause. While showing signs of cooling, the labor market remains tight. The overall resilience of the economy reduces the urgency for rate cuts. Global uncertainties, China's slowdown, and volatile oil prices add complexity. Based on these factors, the scenario for the 18th, the Fed is likely to keep the federal funds rate at 5.25 to 5.0. Haha, see? So, in other words, Warren is basing the information strictly off what he read at the meeting. Bodie is taking the intervening information that he's got, the data that the Fed is talking about, and putting it on there and saying, no, they're not gonna lower rates. While they may acknowledge progress in cooling, the data doesn't provide a compelling case for an immediate cut. The Fed will emphasize its commitment to bring stability. The Fed may also, this will be fun to go back to later, right? The Fed will do this and that. Okay, great. Brent hit 76 today. Why the huge discrepancy? Please check your sources and also let me know if that affects your analysis. All right. Not going to dig into it. When I'm just working with him, I get really like, I want to know where your previous sources. Look how he's suddenly putting up every single footnote. Oh, you're so funny. The pricing orange. It's like being yelled at by the teacher, right? He's like, oh no, here's my sources. Ongoing worries of global economic growth are contributing downward pressure. US dollar typically makes oil more expensive for holders of other countries, a stronger dollar. What are you talking about? Oh, reason for the price drop in oil. Inventory data, blah, blah, blah. The market is still digesting the implications of the Federal Reserve decisions. OPEC plus cuts may be perceiving the oversupply situation and anticipating changing policy. Implications, given the significant drop in oil prices, lower oil prices contribute to easing inflationary pressure. The sharp drop in oil prices might be interpreted as a sign of weakening global demand. Reduced inflationary pressure from energy prices, the Fed may be more inclined to maintain current interest. If the Fed interprets oil prices as a sign of weakness, revised outlook, given the situation, the Fed is now more likely to keep the fund rates unchanged. Oh, but with a more dovish outlook, they may emphasize the need to carefully monitor, blah, blah, blah. Well, more likely to keep it unchanged. The approach allows the Fed to maintain its commitment to price stability while acknowledging changing prices. In conclusion, the sharp decline in oil, 76, we introduce a new dynamics of pressure. Yeah. I think the oil decline is more related to the declining fear factor as Mideast peace efforts are looking like they might work. And by the way, this is how you use an AI. You have a conversation with it. You say, did you think of this? Because that's the key. It's like they don't think of stuff. It's just like an employee. Did you think of this? Did you think of that? And again, in the same session, it'll learn and grow from the experience. And then you've got to manage it. So that's why I try to keep very long sessions to get that growth. And then I try to have apply that to the next session that I build. So recent progress, ceasefire in Gaza, diplomatic momentum, Israel accepts the US proposal, the oil market is sensitive to geopolitical risk, Brent prices drop, blah, blah, blah. Oh, now you know where they went to. Despite the current decline, analysts and organizations like the Energy Information still forecast potential price increases. Yeah, but those are based on the see, those things are still based on the timing. In conclusion, your assessment of oil price decline is significantly related to reduced tensions, show promise the potential for ceasefire, easing tensions has indeed played a critical role. However, it's important to consider the factor alongside market dynamics, of course, obviously. All right, anyway, so that's where we are with that. And we don't have a Powell thing, so that was my mistake, but we're good. So that's where we are. And I guess the overall take on the whole thing is that no, there's not likely to be cuts in September. That is disappointing to the market, and the market is pretty flat about it. Let's see what the S&P is. Ooh, oil tried to get over 72, but it didn't quite make it. Oops. Man, my power is going to go out any minute. It doesn't go out, it blinks, but when it blinks, I lose my router and stuff, so unfortunately. Nope, pretty flat. Okay, so not a bad day. It's a very flat day, and we're ingesting this information. It's not the worst thing that could happen. You know, consolidation on the way back up is not so terrible. And and let's just finish off this thing then while we can. So we talked about IVZ, Nokia. Oh, the nice thing about stocks that are like less than $5, and it's a multi-billion-dollar company, it just happens to have a low stock price, is that options, when you're in those low ranges, the options can be have disproportionately large amounts of premium. Now that's terrible when you're buying the options, but when you're selling the options, it's fantastic. So we take advantage of that. Like the $5 puts are $1.10. They're 20% of the price of the stock. Actually, 25% of the actual price of the stocks. So we're selling the $5 puts for $110. That is a net of $390. So our net is here. which is not very much below the current price. But again, I'm picking value, super value stocks that I'm very confident have made a floor. And then we're just saying that we think they're going to be at least a little bit higher than they are now. And notice our spread is only 4 and 450, but that works out to a $2,050 spread, $2,050 in net cash, put into a $75 spread, and the spread is $5,500 in the money. So this is 100+% profit, 150% profit in the money at the beginning of the spread. And the upside potential is 265% on this one. IMAX, wow. As soon as it hits my building, we're screwed. That's when it's going to go up. So IMAX is what was I going to say? Oh yeah, so IMAX movie people are coming back. Box office is getting much better. They're installing 10%. They're adding 10% more theaters. So they've got strong orders for more IMAX theaters. More theaters means more revenues, right? You install 10% more theaters, you have 10% more revenues next year. So that's built-in growth. So on top of what they got now, on top of the rising box office, they're going to have 10% more revenues next year because of all the installed theaters. And next year, they're going to install another 10% more theaters. So unless there's another disaster to the film industry, we should be in good shape. And this is a writer's strike year. We had the writer's strike this year. That impacted their earnings a lot also. So all those backed up movies are coming on the slate. So I love IMAX going forward here. Again, we went with a conservative spread. We sold the $20 puts, which is right where they are. We bought the March. These options only go out to March. They don't have longer options, so it's a short-term play. But even though it's a short-term play, if we can get to 22 in March, so we're hoping we're hoping that the Christmas movie season, which is what they'll be reporting in March, is strong. And if that is the case, then we have a spread here that can make 280% by March. That's like what, 8 months, 7 months, whatever the hell it is. And even if it stays at 20 though, we're gonna make 166% by March on this trade. So of course you love this stuff. And that's the point. We make that money, which is a double or more than a double on this trade. We have that money already set to go to a new trade in March. If you do that a few times, you really boost your portfolio significantly. And then, like I said, rather than buy a stock, we just sell the puts of stocks that we like. Now, Target, we sold 5 of the 2026-120 puts, and Target already had good earnings for that. AT&T, we sold some puts on AT&T, and Pfizer, we sold some puts on Pfizer. And again, we're just promising to buy the stock if it goes lower. We don't think it's going to go lower. We probably keep the money. So overall, there's $14,000 in, which is 14.5% profit potential is built in. So of the 100,000, we haven't deployed much of the cash, but what we have done is we've taken in the first quarter of trading this portfolio, we're taking a 14.5% profit. Now, if this is going well, because we've only used a very small part of our total allocation, if this goes well in the second quarter, in 3 months from now when I'm on the show again, we'll do more trades. In the next portion when we do it, we're going to do another block of trades. And if this is going well, for one thing, if it's going really well, you do what we call releasing the allocation block. In other words, you promise to buy something, but if the stock goes so far higher that it's no longer likely it's going to hit, like Target is going to be like that. It's going to go so far higher that the puts are never going to come in. Then I'm not going to count that as my allocation block because I won't need it. It's no longer a risk, and I can then put that money to use somewhere else. And that's how it does it. It's slow to build at first and slow to build. Again, this is 1 quarter at 14.5%. So we're at a 60% annual pace right now with our first bunch of selections. If it goes well, if it doesn't go well, maybe we'll only meet 20% or whatever. So we're at a 60% pace now. But then next year, we'll have 160% of the money and we get to do it all again. And if we do 60% of 160%, that's 100% of our original 100,000. And that's how these things stack up and grow. So it's a great portfolio. It's this is the fourth time we've run the money talk portfolio. It's always been gangbusters, even though it's an incredibly conservative portfolio. And that's because we pick such conservative stocks and such deep values that we tend to just, mint money off of this thing. So I love that. And again, if the Fed there's no path in which anybody's saying the Fed is going to raise rates, not very unlikely. So if the Fed is at some point over the next 18 months going to be lowering rates, that's going to be a market positive too. So notice I'm staying away. We don't have the tech stocks. We're not getting the high flyers. We're picking real deep value plays here that are hopefully going to be defensive if the market comes down again. But if the market doesn't come down again, this is going to make money like you wouldn't believe. So great portfolio, great new way to start. $100,000 is what we're looking for in this portfolio. But so far, we've only used $14,000 in cash and probably $60,000 in margin, I would say, out of 200. That's where we're at so far. Anyway, thanks everybody for coming. I appreciate it. And we will do this all again next week. All right. So take care, folks.